Hi everyone, and welcome back to the channel. Today we're going to discuss what's going on with mortgage rates, what's happening in the market, and what you should be doing in today's current market conditions. So let's get into it. First things first, what's going on with mortgage rates? Well, the best source I can find is Mortgage News Daily. I'm not sponsored by them or anything, but I use them consistently to find out what's going on in the housing market, where rates are, and what I think is going to happen in the future. So they have really good articles about why current rates are at what they're supposed to be at and why we think the future could go up or down and what we're going to see in the future in the market. So make sure you check them out. I left the link in the description below. But right now, we're going to check out their chart on where the 30-year interest rate is for mortgages. So rates as of 9/27 were up at 7.08%. Something to understand about these rates is that they're for well-qualified buyers. That mostly means that you have 20% down, you have a low debt to equity ratio, and you have a credit rating over 740 or maybe 760. It depends on which institution you're using. So if you met those qualifications, then I'd say it's safe to assume that these rates are accurate for you. On the other hand, if you're someone that's putting 5% down with a credit score around 740 and I'd say a medium to low debt to equity ratio, I assume your rates are going to be a good bit higher, another 50 to 100 bips higher than the rates you see here. So that's 0.50% or 1.0% higher. So that leads to the question, are many people putting 20% down? Well, yeah, good many people still are. It's been over 40% since 2011. But what others won't tell you is that the first-time home buyer is only putting down 6% on their current mortgage. Why is that important? What does that mean? Well, that means that these people are getting way higher interest rates on their mortgage than what we're seeing in the average 30-year that this is showing on the chart. And that also means that you're going to owe a lot more interest because your principal balance is so much lower when you start the loan. Makes a really big difference in what your payment's going to be, but can also be nice for people because they have a lot less money they have to put down up front and they can maybe get into a house sooner. So what did happen to mortgage rates? Why are they over 7% when they were just at 3% less than a year ago? Well, that's because the Federal Reserve has raised the federal funds rate consistently this year. It means it's been more expensive to get consumer debt. But more importantly, and what the mortgages are actually based on is the 10-year Treasury note, which is up around 4%. It's really high if you look at the chart of how high it's been in the last couple of years. Really causing interest rates to be very high for mortgages and making a big dent on what people can afford to pay for. Now, the Federal Reserve understands this, they know this, and they actually want this to happen. So don't be too alarmed, but it is going to cause some pain in the market, so make sure you're prepared. Some markets are starting to show signs of coming down, and that leads us to what's going to happen in the future. No one knows for sure what's going to happen, but here's a few things to consider. Single family housing is starting to really rise up. Yeah, I know, most people aren't building as many as they used to, and builders are really slowing down because of the interest rate hikes. But there's been an increase due to a lack of demand, and that's because interest rates are going up. Another thing is the prices are starting to come down a little bit because people are backing out of their current contracts to try and get in these single family housing. That makes a really big deal for the people building the houses and taking on this initial debt to try and sell it to their first home family. Another thing to consider is the amount of listings that are on the market, and that's seen a real downturn. And there's two reasons for that. Number one, it's really tough to get new home buyers to commit to getting in these houses, and that's because the interest rate is so high. Just doesn't really make sense for them at this current time if your interest rate is around 7%. Another reason is people that are buying houses probably have had a house before, and they're probably locked in at a rate much lower than 7%. Some people are locked in at 2.75, 3%, and to make that huge jump in interest payments from 2.75 to 7% is really hard to get around. People just don't want to do that. They're locked into these low rates. It makes sense for them to keep them. They don't want to get out of the house only because these rates were so low that they have on their old mortgages. So that's causing people to stop putting houses on the market, and that's also kind of drying up demand for these houses being on the market. Now, I don't see listings coming down as far as they were, I don't know, during 2008 during the housing market crash, but I do see some significant hurt that we're going to have. Yeah, I don't think it's going to be 30, 40, 50%, but I can definitely see a 10 to 15, maybe even 20% drop in housing values if you're not careful. Things to consider are what market you're in, what it looked like pre-pandemic and what it looks like now that we're coming out of this. So make sure you're looking into what your area has, what it has to offer, what you think the rate's done for you if it's gone up a lot for you. Obviously take that in consideration, but also look to see what market values have been since 2020. That's something you really need to consider. Well guys, that's all I have for you today. I hope you enjoyed the housing market video that I had today. Hope you guys look into your own housing markets, decide what's best for you, and make the right choice for you. Just as a last bit of caution, if you are looking about buying a house, just be aware that interest rates are really high. You probably will have the chance to refinance at some point though, so don't get too discouraged. And personally, if my rate was over 6%, I probably would just try to wait this out and get a house whenever market's a little bit better time for you and your family. But obviously, do what's best for you. That's what this channel's about. We're trying to make financial decisions based on what's best for you, your family, and your life. So make sure you're looking into that. If you like this type of content, go ahead and hit the like button, subscribe, and make sure to leave a comment down below. Otherwise, I'll catch you guys in the next one.